Welcome to our deep dive, into the world of South African exchange-traded funds, or ETFs for short. We've got a stack of fun fact sheets from Satrix, one of South Africa's leading investment firms, all dated November 30th, 2024. So think of this as your cheat sheet to understanding what's hot and what's not in the South African market, and more importantly, what it all means for investors like you.
Yeah, it's remarkable how these fact sheets can give us a glimpse into the overall economic landscape,
Hmm.
both within South Africa and globally. It's like having a backstage pass to the financial markets.
Okay, so let's lift the curtain and start with the big picture. What was happening in the third quarter of 2024? The Satrix fact sheets point to a pretty interesting trend. Central banks around the world seem to be hitting the brakes on interest rate hikes. The U.S. Federal Reserve, the European Central Bank, and even the South African Reserve Bank were all cutting rates. What's the story there?
Well, it seems like concerns about slowing global growth were starting to overshadow worries about inflation, which had been cooling down a bit, both globally and in South Africa. So central banks were trying to stimulate their economies by making it cheaper to borrow money. This is important because interest rates have a ripple effect across all sorts of investments, including those held within ETFs.
And speaking of global influences, it seems like China was making a splash with a late stimulus push to jumpstart their economy. The Satrix fact sheets mentioned that this move had a noticeable impact on global markets, especially the MSCI China Index, which saw a significant rise.
Absolutely, and that's a prime example of how interconnected global markets are. What happens in one corner of the world can send shockwaves across continents, influencing investor sentiment and ultimately impacting how your investments perform. So even if you're focused on South African ETFs, it's crucial to keep an eye on the global scene.
So with all these factors in play, how did global markets actually fare in the third quarter? The Satrix fact sheets paint a somewhat mixed picture. U.S. stock-heavy indices had a relatively quiet quarter. While emerging markets seemed to be having a party, global bonds, on the other hand, were pretty steady.
Yes, and this just goes to show the importance of diversification. If you're only invested in one type of asset or region, you could miss out on potential growth elsewhere. That's where ETFs can be a real game changer. They offer a way to easily spread your investments across different asset classes and regions, potentially smoothing out those bumps in the road.
Now let's zoom in on South Africa itself. The fact sheets highlight some interesting trends within specific sectors. For instance, tourism was absolutely booming, with companies like Southern Sun and Sun International reaching record highs in their share prices. Why the sudden surge in tourism?
This tourism boom likely stems from a few factors. There's pent-up demand from the previous years when travel was restricted. A favorable exchange rate is attracting international visitors. And perhaps there's also a sense of optimism surrounding the new government of national unity. This suggests that the tourism sector could have some legs, making tourism-related ETFs an interesting option for investors looking for growth potential.
And the good times weren't just confined to beaches and resorts. Construction was also experiencing a wave of positive sentiment, with companies like Wilson Bailey, Homes Ofcon PPC, and Robex all seeing impressive gains.
This indicates confidence in South Africa's infrastructure development and potential for future growth. When construction companies are thriving, it often signals a belief in the long-term prospects of an economy. So this sector could be worth keeping an eye on for investors interested in tapping into that growth story.
But not every sector was enjoying the sunshine right. The Satrix fact sheets point to some significant headwinds for the mining industry. It seems like Transcend's declining capacity was a major culprit, leading to potential job losses and negative returns for companies like African Rainbow Minerals, Sasol, and Sibanye-Stillwater. That's a pretty stark contrast to the booming tourism and construction sectors.
It is indeed. It highlights the importance of understanding the nuances of each sector and the factors that can impact its performance. Even in industries with strong global demand, like mining, internal challenges can significantly hinder profitability. For investors, it's a reminder that due diligence is essential. You need to look beyond the headlines and really understand the dynamics of a sector before diving in.
All right, so we've set the stage with a broad overview of the market landscape. Now let's get down to the nitty-gritty and explore those Satrix ETFs in more detail. What kind of investment strategies do they offer, and how can they help investors navigate this complex market environment?
That's where things get really interesting. Each ETF is like a unique recipe, blending different ingredients, or in this case, assets, to create a specific flavor profile. Let's take a closer look at some of these recipes and see what they can tell us.
First up, we have the Satrix ALSI Index Fund. This was like a classic dish. Simple and straightforward. It tracks the FTSE JC ALSI, offering broad exposure to the South African stock market. If you look at its sector allocation, financials and resources take the lion's share. And it operates with a low tracking error, which means it's designed to closely mirror the performance of the underlying index.
So if you're looking for a no-frills way to essentially own a slice of the overall South African stock market, this is a solid option. It's like the foundation of a well-balanced investment portfolio, providing that core exposure to the South African economy.
Next, we have a couple of balanced funds, the Satrix Balanced Index Fund and the Satrix Low Equity Balanced Index Fund. These are more like multi-course meals, blending investments in South Africa with a touch of global flavor. They both use something called the Smart Core Index methodology. It might sound a bit fancy, but it essentially means they target stocks showing strength in momentum, value, and quality.
Think of Smart Core as a sophisticated stock selection process. Instead of just tracking a standard index, it actively looks for companies that exhibit those three key characteristics. The idea is that by combining these factors, you can potentially achieve more consistent returns over the long haul.
And the main difference between the balanced and the low equity balanced? Well, as the name suggests, the low equity option holds a higher proportion of bonds and cash. That makes it a potentially good fit for someone who prefers a slightly milder spice level, so to speak.
Exactly. That lower equity allocation creates a more conservative approach, aiming to dampen the volatility that can come with a higher concentration of stocks. It's like choosing a dish with a lower heat level. You still get the flavor, but it's a bit more manageable for those who prefer a smoother experience.
Now let's talk about a sector that often gets investors buzzing. Technology. The Satrix Capped Indie ETF is all about equity exposure, tracking the capped SWOX, which focuses on the heavy hitters in the South African market. And this one has a pretty significant allocation to the technology sector, 33.2% to be exact. We're talking big names like Naspers Prosus and British American Tobacco.
So this ETF is for those who are bullish on South Africa's tech scene and want to capitalize on its growth potential. Naspers and Prosus in particular have a global reach. So this ETF offers investors a way to tap into the broader tech trends, not just those within South Africa.
Then we have the Satrix Dividend Plus Index Fund, which seems like it might be a favorite for those who prefer their investments to serve up a regular side of income. Its sector breakdown leans heavily towards financials and resources, reflecting those industries' tendency to pay out dividends.
This is a great example of how ETFs can be tailored to specific investment goals. If you're looking for a steady stream of income from your portfolio, dividend-focused ETFs can be a good way to achieve that. And in a market like South Africa, where certain sectors have a tradition of paying out dividends, this can be a particularly appealing strategy.
For those who like things a bit more balanced, there's the Satrix Equally Weighted Top 40 Index Fund. It gives each of the top 40 South African stocks an equal weighting, so no single company gets to hog the spotlight.
This is an interesting approach because it prevents the performance of the ETF from being overly influenced by just a few giant companies. It's a way to gain broader exposure to the top 40 while potentially mitigating some risk.
If you want to dive deep into the heart of South Africa's financial sector, then the Satrix FINI ETF is the way to go. Its sole focus is on financial institutions, with banks like FirstRand Standard Bank and Capitec taking center stage.
This is a prime example of a sector-specific ETF, allowing investors to really hone in on a particular industry. In this case, you're betting on the growth and stability of South Africa's financial institutions. Of course, the performance of this sector is closely tied to factors like interest rates and overall economic growth, so it's not without its risks.
Next up, we have a trio of funds for those who want to venture beyond South Africa's borders. The Satrix Global Aggregate Bond Feeder ETFs, the Satrix MSCI Emerging Markets Feeder ETF, and the Satrix MSCI World Feeder ETF. These offer pathways to international bond and equity markets, allowing investors to add some global spice to their portfolios.
Think of these feeder funds as bridges to overseas investments. They allow South African investors to access funds that are based in other countries. Simplifying the process of diversifying your portfolio internationally, this can be a valuable tool for reducing risk and potentially tapping into growth opportunities in different regions.
For those who prefer a smoother investment journey, there's the Satrix Low Volatility ETF. As the name suggests, it's all about minimizing those stomach-churning ups and downs by investing in stocks known for their relatively stable prices.
This is a good illustration of a factor-based ETF. It's not simply tracking a broad market index. It's specifically targeting stocks that exhibit lower volatility, which can be a great option for investors who are more risk-averse. It's like choosing a scenic route with gentle curves rather than a roller coaster ride.
We also have the Satrix MAPS Protect ETF
Mm.
and the Satrix Sharia Top 40 ETF, which cater to specific investor preferences or requirements, offering a tailored approach to navigating the investment landscape.
It's worth noting that the ETF universe is constantly expanding, with new funds being launched to meet the evolving needs of investors. So if you have specific investment goals or criteria, whether it's ethical investing or something else entirely, it's worth exploring the options available.
Now let's circle back to the South African market. The Satrix Midcap Index Fund offers a unique perspective by focusing on mid-sized companies. They've moved beyond the startup phase, but still have substantial room for growth.
Mid-cap companies often represent a sweet spot for investors seeking a blend of growth potential and stability. They're not as risky as small-cap companies, but they may offer more upside than large established corporations. This ETF provides a way to tap into that segment of the market.
And to round out this part of our deep dive, we have two more factor-based funds, the Satrix Momentum Index Fund and the Satrix Quality Index Fund. The Momentum Fund is like a surfer, riding the wave of stocks that are showing strong recent price trends. The Quality Fund, on the other hand, is more like a discerning connoisseur, seeking out companies with rock-solid financials and a proven track record.
These are good examples of how factor-based investing can be applied within a specific market. It's about identifying those key characteristics that drive performance and then building a portfolio around those factors. It's a more nuanced approach compared to simply tracking a broad market index.
Okay, so we've covered a lot of ground, but before we move on to the next course, let's talk about something that's crucial for any investor: fees. The Satrix fact sheets mention the total expense ratio, or TER, and transaction costs, or TC. Can you break down what these are and why they matter so much, especially for long-term investors?
Absolutely. The TE is like a small annual fee that you pay for the fund's management and operating expenses. Think of it as the cost of having experts manage your investments. The TC, on the other hand, are incurred when the fund buys or sells assets within the portfolio. Now, here's why these costs are so important. Even small differences in fees can have a significant impact on your returns over the long term.
So it's like death by a thousand paper cuts.
Exactly. Those seemingly insignificant percentages can gradually chip away at your profits, especially if you're investing for decades. So it's always wise to compare fees across different ETFs before making a decision. The good news is that ETFs tend to have lower fees than traditional mutual funds, which can be a big plus for cost-conscious investors. It's all about finding those hidden costs and making sure they don't eat away at your returns over time. After all, every rand saved on fees is another rand that can potentially grow your wealth.
Now, while we're on the topic of growth, the Satrix fact sheets also provide some insights into the past performance of their EPFs. Some funds have posted some pretty impressive returns, while others have been a bit more modest. What should investors make of these numbers?
It's tempting to get caught up in those eye-catching performance figures, but it's crucial to remember that past performance isn't necessarily a predictor of future results. The market is a fickle beast, and what worked well in the past might not continue to do so in the future.
Right past performance is not indicative of future results. We hear that disclaimer all the time, but it's easy to forget when you see those big, bold numbers.
Exactly. Those past returns can give you a sense of how the fund has performed historically. But it's essential to consider other factors like the fund's investment strategy, its risk profile, and how it fits into your overall investment goals.
Speaking of specific goals, let's shift our focus back to some more of those Satrix ETFs. We've got the Satrix NASDAQ 100 Feeder ETF, which seems like a direct line to the heart of the U.S. technology sector.
This ETF tracks the NASDAQ 100 index, which is heavily weighted towards U.S. tech giants. It's a popular choice for investors who are looking for exposure to the innovation and growth potential of that sector. Of course, it's important to remember that technology can be a volatile sector, so this ETF might not be suitable for everyone.
Then there's the Satrix Property Index Fund, which focuses on South African real estate investment trusts, or REITs. It seems like a good way to tap into the property market without actually having to buy a physical building.
Exactly. REITs own and manage income-producing real estate properties. And this ETF offers investors a way to participate in that market without having to deal with the hassle of being a landlord. This particular fund has a significant weighting towards retail properties, which could be influenced by the performance we saw in the tourism and consumer sectors earlier. It all ties back to that broader economic picture we were discussing.
Now let's revisit the Satrix Smart Core Index Fund, which we touched on briefly earlier. It utilizes that Smart Core methodology, aiming to select stocks based on momentum value and quality. The fact sheet highlights its outperformance compared to both the capped weighted benchmark and the average of the single factors.
That's an interesting observation. And it suggests that the blend of factors might be creating a synergy that leads to more consistent returns. It's like having a well-rounded team of players, each with their own strengths, working together to achieve a common goal.
And the fact sheet even provides some specific examples of the fund's investment decisions, like adding Dischem to the portfolio and increasing positions in MTN Group and the Foschini groups.
Those examples give you a glimpse into the fund's strategy in action. It's not just a static portfolio. It's actively adapting to market conditions and making adjustments to capitalize on potential opportunities.
Okay, so we've covered a lot of ground, but there are a few more Satrix ETFs we need to explore. We've got the Satrix Value Equity ETF, which seems to be all about finding those hidden gems in the market, those companies that might be undervalued by investors.
This ETF embraces the value investment philosophy, which focuses on identifying companies with strong fundamentals, but whose stock prices might not reflect their true worth. It's like being a bargain hunter in the stock market.
So it's like looking for those diamonds in the rough.
Exactly. The fund managers are searching for those companies that have been overlooked or perhaps unfairly punished by the market. It can be a contrarian approach, but it has the potential to yield significant returns if those undervalued companies eventually gain recognition.
Looking at its sector allocation, the Satrix Value Equity ETS seems to be placing a big bet on financials, with a hefty 38.05% allocation.
That's a significant weighting, and it suggests that the fund managers see value in the South African financial sector. They might believe that these companies are well-positioned for growth despite any short-term economic challenges, or that their stock prices haven't caught up to their true potential.
And there's also some exposure to basic materials, consumer discretionary, consumer staples, telecommunications, technology, and energy.
That diversified sector allocation is a way to manage risk. It ensures that the fund isn't overly dependent on the performance of any single industry. It's like having a balanced diet for your investments.
Okay, before we move on, let's not forget about the tax man. It seems like many of these Satrix ETFs qualify for some pretty attractive tax benefits under Section 12T of the Income Tax Act in South Africa. Can you explain what this means for investors?
Absolutely. Section 12T allows South African investors to enjoy tax-free dividends, income, and capital gains on investments within these qualifying ETFs. It's a significant advantage that can boost your overall investment returns.
And just a quick reminder for our listeners in South Africa, there's an annual contribution limit of R36,000 and a lifetime limit of R500,000 for these tax-free investments.
That's right. It's always a good idea to familiarize yourself with the specific rules and limitations associated with any tax benefits to make sure you're making the most of them.
Now, getting back to the Satrix ETFs, we still have a few more to discuss. Let's talk about the Satrix Top 40 Index Fund. What's the story with this one?
The Satrix Top 40 Index Fund is designed for investors who want to track the performance of the 40 largest and most liquid companies listed on the Johannesburg Stock Exchange, JSE. It's a straightforward way to gain exposure to the blue-chip companies that dominate the South African market.
So it's like owning a piece of the South African stock market's A-team.
Precisely. It's a popular choice for investors seeking broad market exposure. The performance of this fund will closely mirror the movements of the JSE Top 40 Index. So it's a good option for those who believe in the long-term growth potential of the South African economy.
Now let's move on to a couple of ETFs that take a more specialized approach. The Satrix Divi Index Fund and the Satrix ILBI Index Fund. What are the key differences between these two?
The Satrix Divi Index Fund is designed for investors seeking a high dividend yield. It tracks the FTSE Dividend Plus Index, which consists of companies with a proven track record of paying dividends. It's a great option for those looking for regular income from their investments.
So it's like a reliable dividend-paying machine.
You could say that. It's a popular choice for retirees or those seeking a steady stream of income from their portfolio.
And what about the Satrix ILBI Index Fund?
The Satrix ILBI Index Fund tracks the FTSE Inflation-Linked Bond Index, ILBI, which consists of South African government bonds that are linked to inflation. This means that the value of these bonds adjusts with the rate of inflation, offering investors protection against the erosion of their purchasing power.
So it's like a hedge against rising prices.
Exactly. It's a good option for those looking to preserve the value of their investments in an inflationary environment.
Now, shifting gears a bit, let's talk about the Satrix NDI Index Fund. What's the investment strategy behind this one?
The Satrix INDI Index Fund tracks the FTSE/JC Industrial Index, which consists of companies operating in various industrial sectors, such as manufacturing, construction, and transportation. It offers investors exposure to the growth potential of these industries.
So it's a way to tap into the industrial heart of South Africa.
Precisely. It's a good option for those who believe in the long-term growth prospects of these sectors. The performance of this fund will be closely tied to the overall health of the South African economy, as these industrial companies play a significant role in its growth.
Now let's move on to an ETF that focuses on a specific asset class, the Satrix JVI ETF. What's the investment focus here?
The Satrix JOVI ETF tracks the FTSE/JC All Bond Index, ALBI, which consists of South African government bonds. It's a conservative investment option that offers exposure to the fixed income market. Government bonds are generally considered to be less risky than equities, making this ETF a suitable choice for those seeking stability and income.
So it's a way to add some ballast to a portfolio, perhaps for those who are nearing retirement or those who are simply more risk-averse.
Exactly. Government bonds tend to be less volatile than stocks, and they offer a steady stream of income in the form of interest payments.
Now let's take a look at the Satrix SWIX Index Fund. What's the story behind this one?
The Satrix SWIX Index Fund tracks the FTSE/JC Shareholder Weighted Index, which is a market capitalization weighted index that includes the largest companies listed on the JSE. It's a core holding for many South African investors, providing broad exposure to the stock market.
So it's another way to capture the essence of the South African stock market.
Yes, it's a popular choice for those seeking to replicate the performance of the overall market. Its performance will closely mirror the movements of the SWIX index, which represents a significant portion of the total market capitalization of the JSE.
Now, for those seeking a more global perspective, let's delve into the Satrix MSCI World Index Feeder ETF. What are the investment opportunities here?
The Satrix MSCI World Index Feeder ETF tracks the MSCI World Index, which includes large and mid-cap stocks from 23 developed markets around the world. It's a great way for South African investors to diversify their portfolios internationally. By investing in this ETF, you're essentially gaining exposure to thousands of companies across different sectors and regions.
Sounds like taking a grand tour of the global stock market.
Exactly. It's a convenient way to access a diversified portfolio of international stocks without having to research and select individual companies from various countries. This ETF offers broad exposure to developed markets, providing a good foundation for international diversification.
Okay, with all these diverse ETFs to consider, seems like there's something for everyone in the Satrix lineup. But before we wrap up this deep dive, let's talk about one more crucial aspect of investing. Understanding your own risk tolerance. How can investors determine what level of risk they're comfortable with? And how can they choose ETFs that align with their individual risk profiles?
That's a great question, and it's an important one. There's no one-size-fits-all answer when it comes to risk tolerance. It depends on a variety of factors, including your age, financial goals, time horizon, and comfort level with market fluctuations.
So it's not just about picking the ETF with the highest potential returns. It's about finding the right balance between risk and reward.
Exactly. If you're a younger investor with a long time horizon, you might be more comfortable taking on more risk, knowing that you have time to recover from any potential losses. On the other hand, if you're nearing retirement, you might prefer a more conservative approach, focusing on preserving your capital and generating income.
And how can investors determine their own risk tolerance? Are there any tools or resources available to help them assess their comfort level with risk?
There are a number of online risk tolerance questionnaires available that can help you gauge your risk appetite. These questionnaires typically ask a series of questions about your financial situation, investment goals, and comfort level with market volatility. Based on your answers, they provide a risk profile that can guide your investment decisions.
And once you have a better understanding of your risk tolerance, how can you use that information to choose ETFs that align with your risk profile?
It's important to consider the risk level of each ETF before investing. ETFs that invest in stocks are generally considered to be riskier than those that invest in bonds. Within the stock market, certain sectors, such as technology, tend to be more volatile than others, such as consumer staples. By understanding the risk profile of each ETF, you can select investments that are appropriate for your individual risk tolerance.
So it's not just about picking an ETF based on its past performance or its investment theme. It's about making sure it fits into your overall investment strategy and your personal risk tolerance.
Exactly. It's all about finding that sweet spot between risk and reward. And that sweet spot will be different for every investor.
Okay, so we've covered a lot of ground in this deep dive. from the overall market trends to the intricacies of specific Satrix ETFs. But before we wrap things up, let's circle back to the listener and provide some key takeaways from this exploration of the South African ETF landscape. What are the most important things investors should keep in mind as they navigate this complex world of investments?
One of the key takeaways is the importance of diversification. By spreading your investments across different asset classes, sectors, and regions, you can reduce the risk of any single investment having a disproportionate impact on your portfolio.
So don't put all your eggs in one basket, so to speak.
Exactly. Diversification is like having a safety net for your investments. It can help you ride out market turbulence and achieve more consistent returns over time.
And what about the importance of understanding your own risk tolerance? How can investors ensure they're making investment decisions that align with their comfort level with risk?
It's crucial to take the time to assess your risk tolerance before making any investment decisions. As we discussed earlier, there are online risk tolerance questionnaires available that can help you gauge your risk appetite. Once you have a better understanding of your risk tolerance, you can use that information to choose ETFs that are appropriate for your individual needs.
So it's not just about following the latest investment trends or chasing the highest returns. It's about making informed decisions that are aligned with your personal financial goals and your comfort level with risk.
Absolutely. It's all about finding that sweet spot between risk and reward, and that sweet spot will be different for every investor.
Okay, so we've covered a lot of ground in this deep dive, but before we wrap things up, let's touch on one more crucial aspect: the importance of doing your own research. While this deep dive has provided a broad overview of the South African ETF landscape, it's essential for investors to delve deeper into the specifics of each ETF before making any investment decisions. What are some key things investors should look for when researching ETFs?
When researching ETFs, it's crucial to go beyond the headlines and delve into the details. Don't just rely on the marketing materials provided by the ETF provider. Take the time to understand the ETF's investment strategy, its underlying holdings, its expense ratio, and its historical performance.
So it's like being a detective carefully examining the evidence before making a decision.
Exactly. It's important to be an informed investor. By understanding the nuances of each ETF, you can make more informed decisions that align with your individual investment goals and risk tolerance.
And what about seeking professional advice? When does it make sense for investors to consult with a financial advisor?
Seeking professional advice can be beneficial, especially if you're new to investing or if you have complex financial needs. A financial advisor can help you develop a personalized investment plan, taking into account your individual circumstances, goals, and risk tolerance. They can also provide guidance on specific investments, including ETFs, and help you navigate the intricacies of the investment world.
So it's like having a trusted guide to help you navigate the investment landscape.
Exactly. A financial advisor can provide valuable insights and support, helping you make informed decisions and stay on track to achieve your financial goals.
It's like having a second set of eyes, a financial expert to bounce ideas off of. All right, so I think we've given our listeners plenty to chew on today, but to really tie it all together, let me ask you this. With South Africa facing these unique challenges and opportunities, what advice would you give to someone who's just starting their investment journey? Someone who's eager to dive into the world of ETFs, but maybe feeling a bit overwhelmed by all the choices?
Well, first off, I'd say don't let the overwhelm paralyze you. It's easy to get bogged down in all the details. But remember, investing doesn't have to be complicated. Start by asking yourself some basic questions. What are your financial goals? Are you saving for retirement, a down payment on a home, or something else? How much risk are you comfortable taking on? And what's your time horizon? Once you have a clearer picture of your needs and your risk tolerance, you can start exploring ETFs that align with those factors.
So it's like building a house. You need a solid foundation before you start adding the walls and the roof. And speaking of foundations, what are some essential resources or tools that new investors should have in their toolkit?
Well, aside from those risk tolerance questionnaires we mentioned earlier, there are some fantastic websites and platforms that offer a wealth of information on ETFs. You can find detailed fund fact sheets, performance data, and even educational articles and videos. Many ETF providers also have their own websites with resources specifically tailored to their offerings.
So it's like having a library at your fingertips. And for those who prefer a more hands-on approach, there are also financial advisors who can provide personalized guidance.
Right. And remember, finding a good financial advisor is like finding a good doctor. You trust someone who understands your needs and someone who can explain things in a way that makes sense to you. So don't be afraid to shop around and ask questions until you find the right fit.
Exactly. It's your financial well-being at stake. So it's worth taking the time to find someone who's truly on your team. Well, on that note, I think we've reached the end of our deep dive. We've explored the intricacies of South African ETFs, dissected market trends, and hopefully empowered our listeners to make informed investment decisions.
It's been a pleasure sharing these insights. And remember, the journey of investing is a marathon, not a sprint.
So pace yourself, stay informed, and don't be afraid to seek guidance along the way. Thanks for joining us on this deep dive, and until next time, happy investing.